That's right. An EV company that produces something like a vehicle a day is worth $65 billion. Just remember, kids, IPO, it's probably overpriced. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of November 8th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. Well, we had another stellar week in the stock market. That's a couple in a row. I'm starting to think we're due for a pullback because, hey, how overextended can we possibly get? The valuations are just absurd. Friday morning was the zenith for the week, the peak for the NASDAQ, the S&P, the Dow Jones, the Russell, and then there was a little bit of a pullback Friday afternoon. I guess the biggest story of the week is that the infrastructure bill did pass, and we'll talk about that a little later in the video. And just a couple quick notes before we get started with the news and earnings. Probably no DD video of any type coming out this week. I'm going to be just sitting back and watching. There was nothing that really caught my eye as a great opportunity. I will be releasing my Theta Wheel video on Tuesday morning because so many people requested to see my trades before I could actually edit the video. I'll be tweeting out my trades for the Theta Wheel series on Monday morning as I make the trades. So I'll go ahead and share the Google Sheet on Twitter. If you're not following me, follow me on Twitter at the Walrus Street. So I'll tweet those out on Monday morning. The video will be posted on Tuesday morning, and that's that. Sidebar, if you guys hear any strange noises in the background, it appears my upstairs neighbor has taken up freaking golf in his apartment. He's teeing off very aggressively into a wall. It doesn't even sound like he's using a net. Although this is a vast improvement over the domestic abuse upstairs in my last apartment, so I guess I can't complain too much. Let's get started with the news. First news story and second news story, they are linked. Elon Musk says Tesla has not signed a contract with Hertz yet, and this halts the stock rally. Well, that hurts. That was way too horrible. Moving on. So there was no contract signed. If you remember last week, we talked about the 100,000 car order from Hertz, where they were going to be purchasing cars at market price from Tesla. And this was going to lead to a domino effect where all the other rental car fleets were going to have to order from Tesla to maintain pace with Hertz. And well, I guess it just doesn't matter because there's no contract yet. And this is just a bunch of people talking. Tesla's shares fell 4% in early trading on Tuesday after a steep jump following the news of the biggest ever order. Musk tweeted late Monday, all good Tesla stories start with the phrase Musk tweeted. If any of this is based on Hertz, I'd like to emphasize that no contract has been signed yet. Hertz's deal has zero effect on our economics, and Tesla did not immediately respond to a request for comment. However, Hertz said in a statement that deliveries of Teslas have already started. We're seeing very strong early demand for Tesla in our rental fleet, which reflects market demand for Tesla vehicles. What's going on here? So Hertz is apparently already taking deliveries of Teslas, and they're seeing demand in their fleets even though they have not signed a contract with Tesla for the 100,000 car order. I'm assuming this means that Hertz just purchased some one-off Teslas that aren't part of that 100,000 car order, and that's what we're going off of here. Either way, I mean, Musk was like pretty straightforward in killing that rally. Oh, but this isn't even the best tweet of the week from Elon Musk. Check this one out. This is regarding the tax avoidance and the capital gains, taxes, realized, unrealized, the whole mess of a situation. Elon Musk tweeted, "Much is made lately of unrealized gains being a means of tax avoidance, so I propose selling 10% of my Tesla stock. Do you support this? Right now, yes is winning and no is not." Musk then says, "I will abide by the results of this poll, whichever way it goes. Note, I do not take a cash salary or bonus from anywhere. I only have stock. Thus, this is the only way for me to pay taxes personally." Oh man, this guy. He is saying that he needs to sell stock to pay taxes, especially if his unrealized gains are taxed. So he's talking about selling 10% of his Tesla shares, which is like $20+ billion given Tesla's current valuation. And I think this is all for show. I think he was planning on selling the shares anyway, but tweeting about this kind of gives him a get out of jail free pass, because if he files that he sold 10% of his Tesla stake, investors might panic, right? But if he tweets about it first and then lets Twitter decide the fate of his Tesla stock, then it kind of softens the blow in some weird, twisted, what the hell is this world that we're living in way. But yeah, it kind of makes sense. You know, the day before, Elon's brother sold like $100 million worth of Tesla stock. So this just kind of fits. Like, it feels like Tesla is reaching its top. Elon wants to sell. He's using the unrealized tax gains thing as an excuse, and he's just using Twitter as a means to get that sale across. But the fact that we have a Twitter poll effectively deciding the stock price for the next couple weeks of $1 trillion company is ridiculous. This is so silly. I can't believe this world that we're living in. If we take a look at the Tesla chart, I mean, it's pretty dumb. There's no technical analysis or anything needed here. We started climbing before the earnings report. After the earnings report, we've just been gapping up. I mean, the earnings report was October 20th. This is 2 weeks ago. We were sitting at a close of $865. Currently, we're above 1,200. So I don't even know what to say about this price movement. Musk thinks this is a top. His brother thinks this is a top. A lot of people seem to think this is a top, and it's a time to sell. And when you zoom out, yeah, this does not look like a healthy rise. This looks like a spike, and this looks like a time to sell. I'm not selling my Tesla, mostly because I don't own any Tesla. I might have Tesla in some of my broad market ETFs, I guess, but it's not something that I have as a single stock. So if I did, I would actually sell it right now. But remember, this isn't financial advice. I'm just a guy on the internet. Next news story, Coca-Cola buys full control of Bodyarmor for $5.6 billion in its largest ever brand acquisition. Owning Bodyarmor helps Coke gain market share in the sports drink category, although PepsiCo's Gatorade is far and away the market leader with roughly 70% market share. Coke bought a 15% stake in Bodyarmor in 2018, becoming its second largest stakeholder. Back when Coke bought its stake in 2018, Kobe Bryant was the third largest shareholder of Bodyarmor after investing in 2013, 2 years after its founding. Rest in peace, Kobe. The deal for the remaining 85% of Bodyarmor is not entirely unexpected. Coke said in February it intended to buy a controlling interest in Bodyarmor, although we didn't know that it was going to be like literally the entire company. By touting itself as a healthier sports drink, Bodyarmor has surpassed Coke's Powerade to become the second largest player in the category. I didn't even realize that Powerade was doing that poorly. I mean, Gatorade is delicious. Powerade just tastes like sweeter knockoff Gatorade. It's just kind of a shitty drink. I didn't know that Bodyarmor was gaining that much popularity though, so it only makes sense for Coke to buy them out when they passed Powerade, and they're probably going to be pushing Bodyarmor going forward over Powerade. The only reason that I'm even remotely interested in this is because it really seems like the entire beverage industry is like a 3-horse race. Coca-Cola, PepsiCo, and Nestle. And it's like, if you're founding a drink company, your entire goal is to become large enough and successful enough to one day be bought by Coke, Pepsi, or Nestle. That's all you could do. I mean, there's no competing with those giants. So just eventually you grow large enough and you get bought out. That's the sign of maturity. That's the sign of the top for a drink company, getting the privilege of being purchased by one of these 3 beverage behemoths. Coke's stock price ended up reacting somewhat positively to the news. Coke has a massive amount of shares outstanding, 4.3 billion. This tiny little pop, it may not look like a lot. You know, we had an aggregate move over the last 3 candles of about 1.25%. So this wasn't a huge pop off that news, but it was significant given the amount of shares outstanding for Coke and how much it takes to move the stock. Next news story, Deere says it's done bargaining after striking workers reject a second contract offer. The company says it has made its best and final offer. The Union of Auto Workers are discussing their next steps. The chief administrative officer, Mr. Howes, said there's not more bargaining to be done. We've done all we can do. We don't have a better offer to provide. This is it. This is the company's third offer, and the contract rejected on Tuesday would have given more than 10,000 striking Deere employees an immediate 10% increase in pay, plus an $8,500 bonus for each worker and additional 5% pay raises in 2023 and 2025. That proposal followed a previous contract offer rejected by Deere workers on October 10th. Not really sure how this one's going to play out because the workers have all of the power here. There are not even enough workers for Deere to hire scabs to keep their facilities running. Deere seems to just be in a lot of trouble. Even though they're saying this is the final offer, what do? It's kind of hard to manufacture tractors without workers. It's not like their plant is fully automated. So I expect Deere to actually come back to the table. But at this point, when you see what Deere is offering to the UAW, to the workers, their offer is pretty astounding. The pay raise, the bonus, the guaranteed raises over the next couple of years. This seems like a pretty sweet deal, and we're already on the third iteration, the third offer. And at some point here, you got to think that the UAW is going to be accepting the offer. And when I look at this, I wonder if this is just kind of a power move, because Deere is really the first kind of high profile strike that we've had during this moment where all these workers have power. So I'm wondering if the UAW is making an example out of John Deere, out of this entire situation, to show the other companies that UAW represents the workers for that, hey, they're not messing around. They're not afraid to bring the company down until the workers get more than perhaps they deserve. And I say that because I don't really know much about the industry. I don't know how unfairly the workers were being paid, but this really seems to me like UAW is using this as a power play, not just for John Deere, but for every other company that it's representing the workers for. Throughout this strike, the Deere stock has been remarkably stable. You know, we didn't drop below the low point that we hit back in June, and we've been rising more or less, but it's like every single time there's an article released, there is a pretty big gap up pre-market or post-market. So the stock's holding steady. I think people are in just wait and see mode, and I think honestly that people are assuming some type of deal does get worked out here, even though Deere says they're not going to bargain anymore and the UAW hasn't accepted the final offer yet. Next news story, Pfizer says its COVID pill with HIV drug cuts the risk of hospitalization or death by 89%. It's now the second antiviral pill behind Merck's to demonstrate strong effectiveness for treating COVID at the first sign of illness, and Pfizer said it plans to submit its data to the FDA as soon as possible. That's kind of the long and the short of it. This is going to be for, I'm assuming, people that have already received both doses of the vaccination, because you can still get COVID after being vaccinated. And this pill is going to be taken upon the initial symptoms of COVID, and it's going to be reducing hospitalizations. Obviously, this is a great step. This is a quick, easy treatment, and this feels good. This feels fine, and I think this is a necessary next step for preventing hospitalizations, especially recurrent hospitalizations, which have been a huge expense associated with COVID. The funny thing about this story, though, is the inverse trends of Pfizer and BioNTech stock prices when this news was announced on Friday. If you remember, Pfizer and BioNTech had the first vaccine to market about a year ago, and BioNTech is like a German drug manufacturer. They worked with Pfizer, developed the first vaccine, yada, yada, yada. BioNTech shares blew up, everything like that. And now if we look at the stock charts, Pfizer had a huge volume day, and we had a almost 11% rise, gap up on Friday on this news. And if we go over to BioNTech, BioNTech saw a 21% drop in share price. So an 11% rise for Pfizer, a 21% drop on BioNTech's share price. And looking at the chart, it's like you can almost hear BioNTech's share price saying, wait, no, please stop. No, take our vaccine, take our shot forever. Don't take the pill. BioNTech's already way down from its highs that it was hitting back in the beginning of August of like 464. We're already under half of that. They're coming back down to earth. This was their previous area where they were trading about $100, and I'm expecting eventually BioNTech's going to be settling in a little bit above that point. Probably down here in like the 150 range is where the drop is going to be stopping. Next news story, Zillow says it's closing home buying business, cutting 25% of its workers as the earnings miss estimates. I'd love to say we didn't see this coming, but if you watch my videos, we saw this coming. Zillow said it's winding down its home buying unit called Offers, which competes with Opendoor. The company said it's cutting 25% of its workforce while eliminating the unit. And oh, by the way, it reported disappointing third quarter results. The stock dropped about 7.5% in extended trading following a 10% plunge during regular market hours. The shares are now down about 10% for the year as of Tuesday's close. The CEO told CNBC after the report that Zillow's ultimate failure was its inability to predict housing prices accurately. At the start of the COVID-19 pandemic, the market dried up. It then bounced back dramatically, and the prices in many markets have climbed to record levels. When you're running a business dependent on the ability to forecast market prices, and you cannot forecast said market prices accurately, your business is doomed to failure. I don't know why it took them this long to realize. I'm just an idiot with a microphone and a camera, and I realized they couldn't forecast prices accurately when I saw that they were buying homes for 30% above above market value. They were paying a 30% premium, and used home sales at that same time were declining. So how did I see this and they didn't see this? This just seems like an excuse for them to close this wing of their business down because it was not as profitable as they imagined. Zillow's share price, as you can imagine, just dropped off after the earnings. There was a huge volume day, and when you see these gap downs off the big volume candles, you know this is just a whole lot of selling driving the price down. The day of earnings, we had a 10% loss, and then the next day we ended up dropping another 25%. Since then, we had a 3% recovery and then a 2% loss, so we're still effectively down at that low point. Earlier this year, in February, Zillow was up at $208 a share, and right now we're trading at $66 a share. This is an astounding loss. This is unreal. Next news story, Rivian raises IPO price range and could now be worth up to $65 billion. That's right, an EV company that produces something like a vehicle a day is worth $65 billion. Just remember, kids, IPO, it's probably overpriced. Rivian plans to offer 135 million shares priced between $72 and $74, up from 57 to 62, it said in an updated securities filing on Friday, and it plans to go public as soon as next week. That's this week. I think actually they're going public on Tuesday. Rivian, which is backed by Amazon and Ford, plans to go public under the ticker RIVN. The rich valuation would mean Rivian is only slightly less valuable than traditional automotive giants like GM and Ford, which holds a stake greater than 5% of Rivian. The company has never recorded any material revenue and expects at most to generate $1 million in revenue in the quarter ending September 30th, according to its filing. It lost $994 million in the first 6 months of the year. I'm not really good at math, but let's see, we're generating $1 million in revenue and we're losing almost $1 billion in 6 months. That seems to be negative. Oh, there's a whole lot to unpack here. First off, let me say, I don't hate Rivian. Out of all of the next generation EV companies, I actually like Rivian more than most of them. What I don't like is this obscene valuation for Rivian. It's great for Amazon and it's great for Ford. You know, Amazon owns about 20% of Rivian, Ford owns about 5%, so those two companies are incredibly happy with this IPO valuation. I don't know, I think maybe just you can't look at an EV company as a traditional company. Every time we just seem surprised by the valuations of these EV companies, but it seems like they're held on a different standard. I'm kind of bitching about this being overvalued, but at the same time, it's an analog to where Tesla was at the same time. I don't even know. I'm not going to invest in it, but I bet this is going to be one of those ones that IPOs at like $74, but you can't even buy stock on the first day unless you're willing to put forth like $90. And then on the first day or 2 days, it's going to run up to like $140 before coming to crash back down. We've seen this before, and I feel like this is going to happen again. No matter how nice their trucks and SUVs are, and they are really, really nice, there's no way that Rivian deserves to be valued what Ford and GM are valued at. Rivian's valuation is going to be something around the same as Hyundai's valuation, one of the largest automakers in the world. This just seems wrong. Next news story, Peloton shares fall 25% as company posts wider than expected loss and slashes full year outlook. Oh no, the pandemic is winding down and the company that manufactures and sells workout equipment to upper middle class and upper class people is starting to fail. I never would have seen this coming. Peloton reported weakening sales growth and wider than expected loss in its fiscal first quarter. The company also slashed its outlook for the full year amid softened demand for its exercise equipment and ongoing supply chain challenges. This is like the double whammy of a bad earnings report. It's one thing to report a bad quarter, but when you report a bad quarter and slash your future outlook, you're doomed. I don't care what company it is. You are doomed for a double-digit loss in percent of share price. For the 3-month period ending September 30th, Peloton reported a net loss of $376 million or $1.25 per share, compared with net income of $69.3 million or earnings of 20 cents per share a year earlier. That's a big switch. That's almost a $450 million change in the opposite direction. Analysts were only looking for Peloton to lose $1.07 per share. I've been regularly crapping on Peloton, probably more than any company on this channel except for Uber. Rightfully so. I think Peloton was just ridiculously overpriced, and then you just kept seeing bad news story after bad news story. First, their elevated treadmills were like killing babies that were getting sucked underneath them, and then secondly, they were charging subscription fees and threatening to brick $2,000 pieces of equipment if people didn't pay the monthly subscription fee, making the gym equipment the most expensive clothing rack money can buy, but the company is just not doing well. This is not a sustainable model, and this is yet another example of a pandemic company that is just coming back down to a reasonable valuation. This is another one where we had Zillow earlier and it dropped by like 67%. Peloton has done the same thing. We had a high of $171 back in January, and currently we're sitting in at about $55. So this is really kind of a lesson, I think, when we look at Zillow, when we look at Peloton, we look at the housing craze that drove up Zillow after the market kind of subsided the year before. We look at the exercise, work at home craze during the pandemic that drove up Peloton. And when you see these companies that are rising up on these absurd valuations, as investors, we really have to take a step back and we have to look and say, is this sustainable? Is it sustainable for every Karen in America to pay $2,000 for a cycle at home and then a $40 monthly subscription fee for the rest of the life of that cycle? Is that sustainable? No, it's not. It's not. The market for stationary bikes isn't that freaking big. Now, for the next news story, and this is the biggest one of the week, and I want to talk a little bit about it. The infrastructure bill finally passed, and it wasn't the whole infrastructure bill. This was like the stripped down only infrastructure bill, which honestly, that's what it should have been in the first place, instead of like stuffing all the pork into the barrel and trying to get random shit passed with an infrastructure bill. No, this is just like roads and infrastructure and things that matter for infrastructure. I'm happy that this one passed. I think this is something that we actually needed. American infrastructure sucked. I don't know if you've ever looked at the bottom side of most bridges, but it sure isn't pretty. Let's actually take a look at what was in the bill, what passed, and what, if anything, we can do to take advantage of this right now as investors. The bipartisan bill passes. What could happen next? Now, it's important to understand that this is actually kind of a two-part bill. One of them was a pure infrastructure. The other one is like a social safety net and climate bill. And the social safety net climate bill, the Build Back Better Act, has not passed yet. And the Build Back Better Act was the one that was like originally lumped in with infrastructure, and it was like 3.5 trillion. And now the Build Back Better Act is down to like 1.5 or 1.75 trillion. So I guess it should be renamed the Build Back Not Quite as Good Act. Even though the bipartisan bill is actually like a $1.2 trillion bill, it actually contains only about $550 billion in new spending. The 1.2 trillion figure comes from including additional funding that's normally allocated each year for highways and other infrastructure projects. I don't think anybody should get like super excited about the $1.2 trillion figure. We really should be focused in on that $550 billion number, because that's the amount of pure spending in addition to the normal spending on infrastructure, the normal annual spending that we do have. So really, this is like a $550 billion bill. I'm just going to go down the list really quickly. $110 billion for roads and bridges, $66 billion for railroads, $65 billion for the power grid, $65 billion for broadband, $55 billion for water, $47 billion for cybersecurity and climate change, $39 billion for public transit, $25 billion for airports, $21 billion for the environment, $17 billion for ports, $11 billion for safety, $8 billion for Western water infrastructure in drought-afflicted areas, $7.5 billion for EV charging stations, and $7.5 billion for electric school buses. So that's a pretty comprehensive list, but at this point, we expected basically everything that's in there to pass. So what can you actually do as an investor to play this? Well, honestly, not much. I think a lot of this excitement for the bill has already been baked into a lot of the stock prices, and $550 billion for infrastructure is not a lot to move a lot of these companies' valuations, because it's going to be spread across so many different companies. I think some of the raw materials providers, some of the larger paver companies, some of the larger steel manufacturers, some of the larger copper producers are going to be benefiting from this most. Cliff. Oh, sorry. I had something caught in my throat there. Past that, what can we actually do? Well, I think one of the cool ways to play this is going to be to go with an ETF like PAVE, which is from Global X, and PAVE has a lot of the infrastructure companies. And if you're just a normal investor and you don't really know what to do, then, you know, looking at PAVE is a decent idea. PAVE is an ETF. It's a market cap weighted ETF, and the holdings are pretty cool. We've got Nucor Corp is the largest holding, which is a steel company, Eaton Rockwell, Kansas City Southern, United Renters, Vulcan Materials, Fastenal, train, all of this is just pure infrastructure. The portfolio is 70% industrials, 21% materials, 3% utilities, and then some other stuff. The only thing that's not ideal about PAVE is that it is at an all-time high. We've had a bunch of green days in a row while we've been negotiating this infrastructure deal for the last week every single day. So I think a lot of people were expecting it to pass, and I don't know if this means that PAVE is going to pull back and provide a better buying opportunity soon. The RSI seems to indicate that. You know, the RSI is way overbought, which on an ETF, that's typically a very bad sign that the ETF is going to be correcting. And if we look at the corrections here, we went from 27 down to about 24. So we are looking at like a 10% plus correction here. So I think maybe we can actually get a bit of a buy-in point, some support here around like 2780. But if we go down to the next level, some support around 2650 or so. So I'm thinking that might be a good buy-in point for PAVE. But another way to play this bill, and this is something that I thought was quite interesting, is buses, EV buses. Again, if we go back to the bottom, $7.5 billion for electric school buses with an emphasis on bus fleet replacement in low-income rural and tribal communities. This funding is expected to allow those communities to convert to zero-emission buses. One company that you can use to play this is going to be GreenPower Motors. This is a company that is a US-based electric bus maker, and it's not able to scale nationally, but locally in California, it is already selling buses to school systems. And plus, I love the name of their bus. Their bus is called the BEAST, stands for Battery Electric Automotive School Transportation. Fantastic name. I'm all on board. And the reason that I say I think EV buses could be the best or at least most dependable way to play this infrastructure bill is because that's like the narrowest defined segment with the fewest possible companies being affected or benefited from that $7.5 billion. No single one of the companies is going to be able to get like the entire contract for $7.5 billion. And instead, I think all of the EV bus makers are going to be benefiting from that $7.5 billion as they have increased orders coming in from the US government. Now, some people might say that BYD is another company, but I don't think so because this is going to be a US infrastructure spending bill and BYD is a Chinese EV bus company. So even though that's a big one, I don't really think so. We've got companies like Grand West and NFI that are both Canadian. Now, GreenPower is technically a Canadian company, but they meet the US requirements for manufacturing, so that's not really an issue. Proterra is getting a lot of attention online, as is Lion Electric, but one company that's not getting a lot of love that's actually a legacy bus maker is Bluebird. I'm sure all Americans watching this video recognize and remember the name Bluebird. Most of our school buses when we were kids growing up were manufactured by Bluebird, and Bluebird still does make internal combustion engine diesel buses, but they also have been making all EV buses for years now, and they have that infrastructure in place. And one thing the government loves doing is going with dependable manufacturers. So I think the biggest beneficiary from this, other than maybe GreenPower, because the money will help them scale their business substantially, is going to be Bluebird. I really think Bluebird is going to be receiving a lot of this money to replace their fleets, and they actually have the scale to do so. Let's take a look at the upcoming earnings for this week. This is like meme stock week. We have Popcorn Company Monday after close. We have Workhorse. We have Palantir, Neo, Coinbase. I mean, it's just every single day there's meme companies. Here's Wendy's. So in case you blow up your portfolio trading options, you can look to see how your future employer is going to be performing Wednesday before open. We have my biggest personal disappointment, Shift, which I'm about to lose about $2,000 on expiring calls because I was too stubborn to sell when I was up 40%, and now I'm just going to be losing all that money. Damn, that hurts. But I still have them, so maybe there's going to be an earnings report miracle. I don't think so. So I think that money is just good and gone. Win some, lose some, whatever. We've got a lot of interesting companies this week. One that I particularly want to look at, and it's not a company that I'm necessarily bullish on. It's actually a company that I'm kind of bearish on. It's Monday.com. Monday.com is a software solutions provider, a cloud software solutions provider for project management, for businesses to pull together projects, to pull together employees. It's kind of a remote work solution, and it IPO'd over the summer, and I think the IPO did not generate a whole lot of hype. Now, you've probably seen the Monday.com advertisements on TV. There's been a lot of them. They have been spending a lot on their marketing, and the advertisements are very, very sleek, and it's very simple, and I like what they're doing, but their valuation is absurd. Here they are on IPO. They IPO'd, low point of the day was about $155, opened at $173.15. We ran as high as $425.84, and right now we're sitting at about $350. If you guys do TA, what do you see on this chart? chart. This sure does look like double top. And right here we have a low point, bottomed out at 317.59. And if you look at the volume candles, there was a whole lot of upward buying pressure at this low point here. So I'm thinking if the earnings report is disappointing, we could actually see it breaking this low point at about 317. And if it breaks that low point, there's nothing preventing it from gapping down to find this area around like 225. The reason I think the earnings report might be disappointing is because the market cap is silly. Right now it has a market cap of 15.48 billion. If we go over to their financials, this just doesn't look right to me. For the last couple quarters, we have their revenue growing 31.9 million, 58.9, 70.6. That's nice growth. But look at this, 70.6 for the revenue. Their market cap is 15.48 billion. The revenue is 70.6 million for a quarter. Extrapolate that out for an entire year, and we're still sitting on less than $300 million. Net income is low. It's negative. They're not profitable, negative 30 million. If we go to the balance sheet, they have cash and cash equivalents, but this is the proceeds from the IPO. And before the IPO, they were broke. They were sitting on 124 million cash and cash equivalents, which was not enough to cover their debt. Their current liabilities at the time before they IPO'd was 166 million. They were sitting on 124 million cash and cash equivalents. So they needed to IPO to generate money. They needed this hype to generate money. Cash flow looks pretty bad. They're losing money every single quarter. That amount is going up. And if not for their financing activities, which look at this magnitude increase on the financing activities from 2 million to 308,000 to 743 million. Now, nothing on those financials screams value buy or even screams justified valuation to me for a software company. And that dip on the chart where we ended up finding the bottom between the two highs coincided with insider lockup ending and insiders selling their shares. And that's never a good sign. I went over to the earnings report and I was looking at their CFO's statement. And I'm not going to read this entire thing, but the general trend here is that revenue is up, their customers are up, their customer retention is really, really high, their R&D costs are going down because their revenue growth is outpacing their investment growth in R&D. So superficially, all that sounds great. And I'm not going to knock Monday.com. Actually, I think it has a pretty solid business model and a lot of the internal metrics look really good. It's just that external valuation seems frankly ludicrous. Monday.com looks extremely overvalued. In terms of forward price to book, Monday's 21.47x is 265.3% higher than the 5.88x industry average. In addition, its 57.9 for forward EV sales is significantly higher than the 3.99x industry average. The whole moral of the story is the price to book ratio and the enterprise value to sales ratios are 200+% higher than any of their competitors, and that's not a good sign. That is a sign of an overvalued company. Now, I'm not actually going to do anything here with Monday.com because it would actually be too expensive with the IV as high as it is to buy puts on the company. But if the company's share price manages to kind of stabilize after this earnings report and the IV falls off, maybe in a couple weeks, I will initiate some puts on Monday.com. And I really feel like the stock is overvalued and the share price is going to be falling off here soon. That's it for me today. I hope you guys did enjoy the video. As always, if you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please be sure to like the video, subscribe to the channel, and if you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. Good luck investing, and I'll see you next time.